It all leads to our talk of the tape. What does today's CPI surprise mean for the rally going forward? Let's ask Liz Young, SoFi's head of investment strategy, joining us today live from the New York Stock Exchange. Liz, nice to see you.
Nice to see you, too.
How much of a blow have the bulls suffered today?
I mean, it's a tough day, and we have to pay attention to that, right? One of the things that we always talk about is you can't fight the tape. The tape is always telling the truth about what sentiment is, but we're coming off such a strong rally and such strong sentiment that it's still yet to be seen whether or not dip buyers will come in here. I mean, 700 points on the Dow is certainly a big drawdown. I think the message that it's sending is that if you were investing and buying stocks based on rate cuts coming soon and coming in a big way, you have to rethink that thesis as we continue to push rate cuts out further and further. Now, that doesn't necessarily mean that the market has to have a 20% drawdown, right? I mean, the longer we wait between hikes and the first cut, the market actually tends to do okay. But certainly today, we need to reprice some of the expectation that the Fed was going to come in and support valuations at this level very soon.
Well, the fear is the great risk that was out there that they're not going to be able to cut anytime soon. And in a worst case scenario, they may actually have to hike again. Now, that's not on the table today, but it makes the PPI later this week even more important. It makes the PCE in a couple of weeks mission critical.
Right. Well, and I would actually argue it is on the table today. It's not necessarily priced into the expectations for rate moves, but the idea and the moves that we've seen in yields today, so the 2 and the 10-year, these 15 basis point moves. Now, we've seen bigger intraday moves before, but these moves are telling me that the market is actually putting back on the table the risk of overheating and the risk that the Fed not only can't exit the hiking scenario, but might have to stay more hawkish as the year goes on. One of the things that I think is really important for people to look at and track as we go forward is what the Fed calls the super core, the CPI super core. That's been stuck at about 4% for the last 7 months. Pre-pandemic, that was about 2 or 3%. So 4% is uncomfortably high. A big portion of that is transportation services, which is up 9.5%. Now, we thought that we knew what all the big problems were in inflation. It was used cars for a while. It was housing for a while. Now we take that out, and it's, again, this whack-a-mole scenario where you've got transportation services, which is actually driven a lot by motor vehicle insurance. That is a new problem, and keeping the services component sticky. Services is always more sticky than goods, so we are certainly not out of the woods here.
But there are some who make the argument that a strong economy at this point in the cycle is more important than rate cuts anyway. That's what you should hang your hat on. I mean, that's what Professor Jeremy Siegel of the Wharton School told me just the other day. I want you to listen to what he said, as he remains bullish and not reliant on rate cuts.
At this particular point, I don't see the need for the Fed to lower. I mean, take a look at all the real indicators. They haven't slowed down. Even the advanced indicators have not slowed down. When they begin to slow down, that and if inflation's under control, which I do think it is, we're going to have those lowering of rates. But I'm not saying that this bull market at all depends on the rates being lowered in March or really even in May.
You agree or disagree with the professor?
So I agree that a strong economy is obviously a bullish thing for stocks. The issue here is that a strong economy also keeps inflation higher, and it prevents inflation and disinflation from broadening out into all the areas that we need to see disinflation. So what it's doing is it's lengthening and elongating this waiting period of when we're going to see the Fed actually be able to come off of their hiking path. And I think that the Fed is going to have a lot more ability to wait than the market is. And a lot of this market move has been predicated on the idea that CPI has come down. I think a lot of people expected it to keep moving in a linear fashion, and that was proven incorrect today, or at least that now it's sort of plateaued at a level that's still uncomfortable. So I think the market is going to have to get to a place where it makes more sense to be trading at certain valuations in the face of a strong economy, yes, but also in the face of inflation that stays higher than we want it to be.